if you plan your balance sheet on a linear basis, growth will solve all problems in a sense. But there are 2 points about Indian banking industry. One is your cost of funds,
Yes.
which can be very high depending on what the regulator does. The other is inflation, which
Yes.
can affect on your profitability. And the third, of course, is asset inflation, which the portfolios that you hold. How do you see, what do you worry about in terms of the macroeconomic fundamentals of India that can affect your business?
No, the biggest worry today is on inflation, because inflation can affect, it'll affect our interest costs to that extent, can, with a lag effect, can affect our asset quality. But otherwise, as the margins are concerned, we should be able to maintain, for the simple reason, ability to pass on the incremental interest on deposit is still intact. So, we should be able to pass on another 50 basis point increase if it happens. If the inflation doesn't come down and policy rates moves up, and another 50 basis point, the corporates will be able to absorb. The reason is, 10 years back when this happened, the corporate balance sheet was not very strong. Today, the corporate balance sheet is quite strong. They, as an interest component, their absorption capacity is better. But if it crosses 50 basis point, I'm a little worried. It may start impacting. But 50 basis point increase can be a challenge with small businesses. So we clearly see risk coming in from there in case interest rate further goes up. So we have a challenge there, right? The inflation is not controlled. But our reading is, I think inflation should get softening.
You think there will be softening in inflation?
I think so. That's what we feel. But
India is not very good at managing its core inflation. I think food prices and today housing costs. It's a country where there's a lot of inefficiencies, and on top of which there is a lot of government subsidies that are very difficult to remove. What do you think India really needs to do to deal with inflation?
Actually, the internal discussion that we have within ourselves and with the regulator, given the conditions in the country, core inflation may be around 5%. I can't expect. In the past, about 2 years back, we're targeting a medium-term inflation rate of 3%. But today, core inflation may be around 5%. We'll come around to that thinking. If the economy is growing at about, say, over 9%, when there is a pressure, actually the first beneficiary of the governmental program today is the purchasing power of the small man. And the first demand comes from the food and the nutrient food. That's where while India is the third largest producer of most of the food items, but still the demand itself is going up so much, it's expected to be impact the inflation. So I don't think in a medium-term basis we'll have a core inflation coming below 5%, and we'll have to live with that sort of higher level of inflation, which is recognized. But having said that, the action, number one, we may have to definitely tackle agriculture productivity, because if this country has to import, there's no country which can supply. The whole thing is expected to go up.
How do you, as a chairman of a state bank, I think you've got 20% exposure to agriculture?
We have about 78%.
Right. How do you view what needs to be done in the agricultural sector in India? And traditional bank lending effectively meant that you write off a lot of that loan. So it's more like a state-directed lending policy. In fact, a lot of foreign analysts don't appreciate that element of state-owned banks in India. What do you think needs to change in the agricultural sector?
Actually, a lot of things need to change. As I said, the productivity is quite low. The land holding is small. We don't have post-harvest capacity built. So from the farm to plate, 50% of the produce gets wasted. So there are quite a lot of things that has to happen. It is in its making. As a matter of fact, we are not only as a bank but as a policy makers at all levels are focusing on it. And we need to get that right because all of us realize that. It's a different matter that in the past we focused on more on the subsidy-based, lending to agriculture. But today the realization is very clear. We need to create warehouses, we need to create godowns, we need to create markets, we need to create negotiable warehouse machine to financing capabilities, a whole lot of things, and a lot of action is taking place on our basis. But it's, as I said, in most of these areas it's unfinished work. But the intent to work on this is very much there.
And how banks themselves lend to the agricultural sector or are involved in the agricultural sector, is that changing? Do you see how?
It's really changing because the point is, while we talk about 60% of our population dependent on agriculture, the fact when you go on the ground is not that 60% are dependent on agriculture. It's a small part of the 60% who are actually dependent on agriculture. But the whole chain that needs to be created, that is where our focus is now coming. Creating, as I said, post-harvest capabilities and a whole lot of things. We're all there.
The government has been going in the direction of increasing its stake in the state-owned banks.
Yes.
What's the message there, and how does that tie your hands, or how does that limit you, or even gives you opportunity as a result of the government taking a policy of wanting to own the state-owned banks even more than they do right now?
Let us look at it slightly differently. First, as a banking institution, if you look at Basel III requirement, there is a need for capital. The biggest challenge for bankers today is not whether government has ownership, but the biggest challenge for bankers today, whether you're able to support your growth by capital. That's the biggest challenge across the world. So if that is so, the capital is a must. Now, your ability to raise capital is directly linked to return on equity. And given the regulation, the way it is evolving, if you look at the norms for liquidity, norms for, I don't think it is possible to raise such a huge capital. With this as a background, I would say government agreeing to bring in capital to meet the capital adequacy requirement is positive at this point.
Okay.
Very, very positive. The government would have said, I have so much of a constraint in terms of budget. How can I bring in capital? Where do you go for the capital? That's the first one. Second point, it gives you leeway. So, for example, if you take Union Bank from me, we have a capital adequacy of 55. The government will do 55%. Government can come up to 51%. That means I have 4% space. I'm growing at about 25%. My book is growing at 25%. That means I need capital. In case government increases its stake to 58% or 60%, next round, after a year or so, I can go for a right issue. But the government will also bring in other minority shareholders. So you have an ability to support growth. That's the first point. Second point is, in Indian situation, whether government as an owner has constrained the performance of the banks, the history doesn't show any way it has negative impact. It is totally ownership neutral. If it is not so, in 2010 and 2000 to 2010, to look at all the numbers, we compare with the private sector banks and public sector banks. The numbers of public sector banks are substantially improved, be it profitability, productivity, or the growth. So it is totally ownership neutral. Why it is so? The government is represented on the board by one member who looks at the government policy implementation, which is equally true for private sector. They are not away from that, except that the member is not represented by the government. But otherwise, there is total autonomy for me as a chairman and managing director or my board to perform. So it has no point in time hindered our ability to compete and the farmer.